Welcome everyone to the virtual Thursday 12 p.m. Eastern Time seminar of the IMF's Independent Evaluation Office. Today's date is October 2nd, 2025, and this seminar is held typically the first Thursday of the quarter. My name is Helene Poirson from the IEO, and I will be introducing our speakers, John and Gloria, today. So this seminar is being recorded. If you'd like to listen to the recording, it will be listed on our website, which is ieo.imf.org. Again, ieo.imf.org. So thank you all for joining us today. It's my great pleasure to introduce our speakers here to give you insights on the decentralization of finance and how central banks and traditional players should respond are John Frost and Gloria Sánchez. Let me give them a formal introduction. John Frost is the head of innovation and the digital economy at the Bank for International Settlements, the BIS. In this role, he leads a team of economists doing research and policy work on digital innovation, and he co-convenes a research priority group on the impact of technology within the BIS. John has published research on fintech, on big tech in finance, CBDC, central bank digital currencies, stable coins, capital flows and technology, and inequality. Previously, he was based in Mexico City at the BIS Americas office, where he was the head of economics. And prior to that, a senior and then a principal economist in the BIS Monetary and Economic Department. He also worked at the Financial Stability Board Secretariat, at De Nederlandsche Bank, VU University in Amsterdam, and in the private sector in Germany. John is a US national from Seattle. He has a PhD in economics from the University of Groningen and an MA from the University of Munich. He's also a research affiliate of the Cambridge Center for Alternative Finance at the University of Cambridge. Our second speaker is Gloria Sánchez. Gloria is the Deputy Chief of Staff of Santander's Executive Chair in Madrid. Previously, Gloria served as Senior Advisor of the Digital Finance Department at the Institute of International Finance here in Washington, D.C. And prior to that, she served as Group Head of Legal for Technology and Digital at Banco Santander, where she was in charge alongside her team of the legal advice to technology areas. So technology contracts, joint ventures, digital banking, digital regulation and financial regulation, data privacy, and intellectual property. Gloria has been the secretary to the board of directors of Santander Digital Services, formerly Santander Global Technologies, among other companies. Her earlier experience included working as an associate lawyer at Clifford Chance, as well as being the head of legal for real estate equity participations and portfolio sales at Banco Santander. She also held academic positions as member of the faculty in different universities and business schools, such as IE Law School, Bucerius Law School in Hamburg, MIT Professional Education, ESADE in Barcelona, Complutense University, and Carlos III University in Madrid. So with that, I will now turn the time over to our first speaker, John. John, you should be unmuted already, so please go ahead. The floor is yours.
Thanks, Helene. Thanks for the kind introduction, and thanks for the invitation to be here. I'm very glad to be able to talk about this topic. I think what I'll be discussing today will be drawing on very current research. I was, preparing this, and there's so much going on at the moment. There are so many developments that I thought, I really need to show kind of the real-time aspect of this and what we're working on. And I think that, as I'll discuss, there are some very important developments that have really noticeably accelerated even in the last few months. And so, I'm very glad to have a dialogue here and to be there with Gloria and yourself, participants. I think that it'll be very useful to talk about what this all means for the financial system and for public policy. And so I'll also make available the slides for those who are interested, including a list of references at the end where you can have further reading about what I'll be talking about. Of course, at the outset, these are my views, not necessarily those of the BIS. And I would like to thank also the colleagues who contributed to helping me prepare this. So the topic of the day is, the decentralization of finance. And of course, that begs the question, what do we actually mean by this? Is finance really becoming decentralized? And what does that mean in practice? So I think it's important to be precise about definitions. And at the outset, I'm going to be very explicit about what we mean by cryptocurrencies, by stablecoins, by distributed ledger technology. And then I'll give a very brief overview of some of what I've been describing of what's happening in real time. So since 2009, the rumblings around cryptocurrencies have risen, I think, audibly. In Hemingway's words, things have changed gradually and then suddenly. We're now in the suddenly phase. And I think that we're seeing now developments that really could reshape how the financial system works. So to be precise, cryptocurrencies are a type of private asset that depends primarily on cryptography and distributed ledger technology or similar technology as part of their perceived or inherent value. That's the definition used by the Financial Stability Board from 2019. Of course, in practice, many people refer to crypto assets rather than cryptocurrencies. Here, I'll use them interchangeably. And then, the follow-up question is, what is distributed ledger technology? Well, DLT is a means of saving information through a distributed ledger, which is a repeated digital copy of data available at multiple locations. So the most well-known is the Bitcoin blockchain, but also Ethereum and others that I'll talk about in just a moment. You can think of them as an append-only database. In other words, it can only get longer. You can add additional information to it. That's held by different nodes or different validators, miners, who may be distributed all over the world. And recently there's a lot of activity around stablecoins. Stablecoins are a particular type of cryptocurrency, and what defines them is that they aim to maintain a stable value relative to a specified asset or a pool or basket of assets. With Doug Arner and others, we discussed this in a paper for the Bank of Spain Financial Stability Review in 2020. These started in 2015 with a few different proposals that tried to overcome the volatility that was inherent in Bitcoin and other cryptocurrencies. And very recently, as I'll show, they're taking off and being used quite extensively as an on-ramp and off-ramp into the crypto ecosystem, but also in some cases for cross-border payments, even for domestic payments and for other purposes. So distributed ledger technology applications in decentralized finance, or DeFi, aim to provide financial services in a very different way. Specifically, they claim, at least, or their proponents claim, that they do so without using centralized entities, which is fundamentally different from traditional finance, TradFi, where we have big banks, financial market infrastructures, central banks, a number of different institutions that are all centralized and have some autonomy over their specific area. In practice, I think things look a little bit different. DeFi platforms often do have quite centralized decision-making, and there are new forms of concentration. So if you look at Bitcoin, which is arguably the most decentralized of the applications we'll be talking about, you still have core developers, you have concentrated mining pools, you have a number of crypto exchanges. So some commentators refer to a decentralization illusion. Fabian Scher at the University of Basel sometimes refers to decentralization theater, that in practice, you may see a very different picture than what's being marketed. And Fabian thinks that there is such thing as truly decentralized finance and truly decentralized applications, but there are quite a few that are not at all decentralized and just posing as such. So why does this matter? I think we'll go back in history a little bit, and I'll ask at the outset: does anyone know what this image is? Of course, since we're here virtually and not in the room, it's hard to read faces or to get a show of hands. But I'll just give you the answer. This is the Genesis block in Bitcoin. This was mined on January 3rd, 2009. This was the very first block in the Bitcoin blockchain. You can see here the hexadecimal on the left, and then on the right, if you look closely, there's this text, which is a headline from the Times, and it says, "Chancellor on brink of second bailout for banks." And I think this says something very important about the ethos of crypto and, of course, the context in which it rose. We all recall this was during the Great Financial Crisis. This is when, just a few months after the collapse of Lehman Brothers, when governments were bailing out banks. And of course, Bitcoin was meant as a radically new proposition. If you go to the Bitcoin white paper, it was marketed as a peer-to-peer electronic cash system. And so it was meant to be something that can be operated without the need for centralized intermediaries. You can have electronic cash allowing online payments to be sent directly from one party to another without going through a financial institution. You can see that even in the very first sentence of the white paper, it refers to the problems of relying on financial institutions serving as trusted third parties to process electronic payments. This suffers from inherent weaknesses of the trust-based model. And so the idea is Bitcoin is trustless. It doesn't depend on centralized intermediaries. It can be operated entirely peer-to-peer anywhere in the world by anyone with an internet connection. So how has that worked out in practice? Since then, of course, we've seen Ethereum, we've seen other blockchains they'll talk more about. But I think, for those who still cling to the idea of decentralization, it's kind of an affront that this is what the market now looks like. I mean, we have very large crypto exchanges that are playing a very important role in the system. We have a number of new entities who are making quite a bit of money off of this system, and you have even some of the most established existing financial institutions, the BlackRocks of the world, the JP Morgans, that see crypto as a new means of expanding their traditional business. Whether that's investing the reserves of stablecoin issuers, or offering tokenized money market funds, or offering blockchain deposit accounts. In practice, I think what we're seeing is there's definitely a role for intermediaries in the crypto ecosystem. And so I think that the discussion of decentralization theater or of the decentralization illusion is live and well. And I think that we have to take the idea of decentralization with a little bit of a grain of salt. But we are seeing some very important things happening in real time, as I mentioned, and let me just briefly walk through these. First, I talked about stablecoins first introduced in 2015, and with a notable surge starting during the COVID-19 pandemic, and in 2021, 2022. Things dropped off a little bit after the collapse of FTX and then of Silicon Valley Bank. But certainly in the last year, we're seeing a surge in market capitalization, now north of $308 billion US. That may not sound like much, but there are, I think, serious parties who project that this could be 2 trillion or more in a couple of years. Already, we're seeing stablecoin issuers becoming very important players in T-bill markets in the United States, for instance, and in some other key markets. And so the question is this big relative to the global financial system? I mean, that depends. What's your definition of big? But if things go wrong in the stablecoin sector, it could really have shocks and spillovers to some very important markets. Meanwhile, there's a Cambrian explosion, if you will, of competing blockchains. So I mentioned already the Bitcoin blockchain, but then there's also Ethereum, which is used quite extensively for decentralized finance and indeed has been dominant in the DeFi space. There are others. There was Terra until Terra Luna collapsed in 2022, and that blockchain essentially disappeared from active use. There's Tron, there's Solana, there's now a number of other layer 1 and layer 2 networks. If you look over time, this is becoming the space is becoming more diverse, more fragmented, and there are good economic reasons why we expect that to continue. In general, blockchains have to, because they rely on a decentralized network of validators, because they need to incentivize those validators to accurately record transactions, to disallow double spending. They often suffer from high fees and congestion and scalability challenges. And we see in practice that when use increases, fees also increase, there's greater congestion. That in turn creates incentives for users to go elsewhere onto other blockchains. And so we see in practice that there is growing fragmentation in this space, quite a few different blockchains. And of course, a lot of the big players are issuing things on multiple blockchains, trying to create interoperability. But that is an ongoing technical challenge in an area that a lot of work is still being done on. Meanwhile, there's rapid growth in the tokenization of so-called real-world assets, RWA, not to be confused with risk-weighted assets, which I think will be familiar with many of those working in bank capital regulation and elsewhere. So this is at a much lower base than stablecoins. It's about 30 billion instead of 300 billion. But we're seeing clearly a rapid uptick, a rapid growth. And the real-world assets you may think that this refers to things that are like a physical asset that you can touch. Not necessarily. I think that, they, in many cases, are regular financial contracts, things like private credit, things like US Treasury debt, things like stocks and bonds. The reason why they're called real world assets is that they don't refer to things that are native to the crypto ecosystem. So instead of crypto assets, these are, things that exist in the real world, in the traditional financial system and elsewhere. So just to show that things are changing very rapidly, there is this very significant growth. And certainly the legislative developments in some key markets, such as the Genius Act in the United States or MiCA in the European Union, are creating a regulatory framework that is likely to support further growth of this market and potentially further interconnectedness between the crypto ecosystem and the traditional financial system. So things are changing very rapidly. Nonetheless, in finance, as in so many domains, there's nothing new under the sun. The functions that decentralized finance aims to fulfill, the things that are actually being done for end users with crypto and stablecoins, are broadly the same things that we've been using the financial system for centuries already. So, in work with Matteo Aquilina and others, we refer to specific functions from the literature on clearing and settlement, pooling of funds to undertake large-scale enterprises, transferring economic resources through time and space, etc. We have examples in the traditional financial system, TradFi, things like payment systems, things like stocks, bonds, and mutual funds, things like loans, mortgages, and pension funds. And then we look at examples in DeFi, and this is all still developing, but we do see, payment systems that look kind of like what we know from the traditional system. We see asset management applications, we see lending applications, etc. And so in many cases, even if the technology is very different and the business models in some cases are quite different, the financial function underlying them is broadly comparable to what we know from the existing financial system. And in that light, I think there's a number of historical parallels that you can draw between what's happening now and what we've seen in financial history. For stablecoins, I think the obvious one, and I'm certainly not the first person to refer to this, Gorton and many others have discussed this at length, but stablecoins can be seen as a return to privately issued money, as we are familiar with from the 19th century US free banking era, for instance. So in the 19th century, there was a period after the Second Bank of the United States was allowed to lapse. So when the United States didn't have a central bank, when it was quite common for private banks and even a number of non-bank entities to issue their own banknotes, which could be circulated throughout the country and used as money for goods and services. So here's just a few examples. I like the Erie and Kalamazoo Railroad Bank, for instance, or Marine Fire Insurance Company, Delaware Bridge Company. Each of these were issued by private institutions and could circulate as money. But notably, the further away you got from the issuer, the more uncertainty there was about the creditworthiness of the issuer, and the more likely it was that these traded at a discount. And in practice, this led to all sorts of complications, the need for new institutions. For instance, there was a need for a clearing bank in Boston, the Suffolk Bank, and people refer to the Suffolk system from 1818 to 1858. Very often people weren't sure if a banknote issued by a particular private bank was still good. And so the Suffolk Bank actually would assess the creditworthiness of individual banknotes. And when something, when it was, for instance, for an institution that had already gone bankrupt and was no longer in operation, they would physically stamp the banknotes worthless, in this case, with red ink. And then it was known that it could be removed from circulation. So many institutions came up to try to serve this market, but it was fundamentally a quite inefficient system where you had many different types of issuers and uncertainty about their credit quality in practice. And we're seeing, to some extent, a return to that system where we have many different private issuers, Tether, Circle, etc. There is now a regulatory framework. We hope that that'll help to ensure that they really do have the assets backing the stablecoins that we expect they do. But it might be that there will be a need for new institutions to try to ensure that one stablecoin, $1 stablecoin of one issuer is equal to $1 stablecoin of another issuer, and that we don't have these large price differences or sudden shifts in practice. There is a question for public authorities of how they should respond to the rise of crypto and decentralized finance. And in other work, again with Matteo Aquilina and with Andreas Schrimpf, we've talked about kind of the high-level options for addressing risks in crypto. And broadly, I mean, these are things that authorities in different jurisdictions are really doing. I mean, you can ban crypto activities, as China, India have done in various forms. Of course, that could eliminate potential harms and prevent losses, but I mean, it can also be a pretty heavy-handed approach, and very importantly, it may not actually lead to the activities stopping. It may just lead to them going underground and happening through other means, and that's something that we do see in practice. So I would argue that banning is not really a viable option, and it may mean that we're also losing out on some of the benefits that we're hoping to get from competition from stablecoins and decentralized finance. A second approach is to contain, so to try to isolate crypto from TradFi and from the real economy. The idea is to create a firewall, if you will, and also avoid giving crypto some regulatory seal of approval. But a fully effective firewall may not really be feasible, and if things do go wrong, I mean, it's very difficult to say we didn't regulate it, hence not our problem. I think society expects from public authorities that we do intervene and try to protect them from harms, even if it's something that's new and maybe not in existing mandates. So the third area is to regulate the sector in a manner that's akin to traditional finance, and to try to address some of the market failures that have led to regulation in the first place. Advantages are ensuring consistency and allowing responsible players to innovate in a regulated space. But of course, there are lots of challenges of mapping crypto and TradFi activities and entities, and there are challenges for enforcement. One counterpart that we spoke with a number of years back referred to the problem of no single throat to choke. So when we have truly decentralized applications, we don't know who's actually responsible, and it may be very difficult to enforce regulations. But as I mentioned at the outset, in practice, I think that we see quite a few centralized intermediaries who are now regulated, and where we do have means of entry. So I think that in practice, regulation is possible. It's just complicated and something that needs to be developed. But that's not enough. I mentioned here at the very bottom, there's something else that public authorities can do regardless of which approach they take, which is to develop an alternative, to build infrastructures that allow for sound innovation. In other words, not just wait for new innovations to disrupt the existing system, but to actively lead with a vision and with public infrastructures that are designed to serve the public good, and that allow for the private sector to build useful services on top. And we see a number of examples in practice where this is happening. So I think fast payment systems are a very important example. I'm showing here a number of specific examples of fast payment systems from around the world. Please excuse the two-letter country codes. We have here Argentina, Australia, Brazil, Costa Rica, Hong Kong, India, and others. And we're looking at the transactions per capita in central bank operated or private sector fast payment systems per month in countries around the world. So what you can see is that in quite a few countries, we already have dozens of transactions per capita per month in fast payment systems. Thailand, for instance, with Prompt Pay, or Brazil with Pix, which I'll show more about in just a moment. They have very rapid uptake. They've seen very wide use for retail transactions, in some cases also for transactions between businesses, often at very low cost with instant settlement. And this has turned out to be hugely transformational and something that can have macroeconomic benefits as well. As you see on the right, many of these same countries see, after the implementation of fast payment systems, a decline in the use of cash. So what we're showing here is cash in circulation indexed to 100 at the year of fast payment system launch. And you can see that concurrently with this dramatic increase in transactions per capita in fast payment systems, we do see a decline in cash in circulation, not to zero. We're still using cash for many purposes, but it is coming down in most cases. And broadly, fast payments are substituting for things that were previously done with small cash transactions. So let me talk more about Brazil. So in Brazil, the Central Bank of Brazil launched Pix in November 2020. And I think it's fair to say that Pix has driven a digital payments revolution. So if you look at the number of users, the number of firms that are active in Pix, the transaction value, all of that, I mean, really exponential growth in the past 5 years. We can see that, over 90% of Brazilian adults now use Pix, the majority of firms in the country. And if you look on the right-hand side, Pix is gaining market share rapidly. It's now used, for several billion transactions per month. It's overtaken credit cards, debit cards, and other means of payments. But notably, credit cards and debit cards aren't declining. I mean, they're still growing too, if at a somewhat lower rate. What Pix is primarily substituting for is actually cash transactions. So this means the overall digital payments market is growing. Banks who are initially quite resistant to Pix have seen quite a bit of benefit. They see non-payment revenues in particular growing as new people are brought into the financial system and also want access to other financial services. And so I think this is a clear success story where we are seeing a public infrastructure helping to revolutionize the payments market and to allow for private sector providers to offer better services to their end users. Going forward, there are a number of other initiatives that can be quite important. We've discussed at length the potential of tokenization. This is one powerful technological capability introduced, in fairness, in the crypto ecosystem. So through Ethereum and other applications, we've seen the potential to tokenize assets, to make them available on a programmable platform. Broadly, tokenization refers to the representation of assets that were represented on a traditional ledger on a programmable platform. And what this means is that you're combining the information about what the asset is, where it comes from, who owns it, etc., with the rules about what the asset can and cannot do, its use in smart contracts, etc. So you have one database that has this logic and the assets itself built in, and it allows for new functionalities that were not previously available. That can be applied to many different areas. So one area that a lot of public sector authorities are experimenting in is the tokenization of government bonds. There are also some private issuers that are experimenting with tokenization of bonds. But what we see in research that we've done on the subject that's linked here is that these bonds in practice are quite liquid. They actually have bid-ask spreads that are lower than conventional bonds in the same currency by the same issuers. And they have issuance costs that are broadly comparable to conventional bonds. So it's still a nascent sector. There still aren't that many tokenized government bonds or tokenized other bonds in the world. But where there are, we're seeing already some improvements in liquidity, broadly comparable issuance costs, broadly comparable yields. And so this means that at the very least, there's no downside so far from issuing these types of bonds. They're being issued on many different types of platforms with many different technologies. So there's a lot of experimentation going on. But this is quite promising and shows that there could be quite a bit of potential to expand this further going forward. So let me conclude. I would argue that decentralized finance is a misnomer. It's not as decentralized as it's made out to be. We're just seeing a replacement of one type of intermediaries with a new type of intermediaries, a re-centralization, if you will. Nonetheless, the sector is growing fast and it's here to stay. I think that we're going to have to contend with crypto and stablecoins. We're going to have to decide how public policy responds. The rapid growth of crypto and stablecoins and decentralized finance puts a premium on real-time monitoring and decision-making. I'll quote here Gudrun Jonsson, who's said in other contexts that you need people who are really trained to understand these things in real time. A bit like how fighter pilots are trained to be able to withstand G-forces and to be able to feel, these sudden changes. I think that we're feeling right now a sudden change. I think a clear acceleration in the crypto stablecoin DeFi market, and so I think this puts a premium on monitoring this in real time and on really making the right decisions early on to influence the growth of the market. Among the various policy approaches, ban and contain are increasingly untenable. So the question isn't whether to regulate, but how to regulate, and what we should do when things go wrong, which I think they inevitably will at some stage. To the private sector, I would note the biggest enemy of innovation isn't regulation, it's crises and the resulting erosion of trust. We know from past crises, there can be good products out there that, lose the public's trust when things go wrong. And I think that's what what the sector should be most worried about, that, not that the regulator comes in and stops them from doing things, but that things blow up and that the public doesn't want to touch that going forward. There is, of course, path dependency. So what we choose now will matter for many years to come. Again, this puts a premium on acting and deciding early about this. And the big question for public sector authorities is, should they delegate responsibility for the future of the financial system to the private sector and to private sector innovators, or should they lead with public infrastructures that lay a foundation for financial development and growth? Perhaps it's clear already what opinion I have on that, but I'm happy to discuss further. And as I've said, fast payment systems and tokenized government bonds are two examples of public sector initiatives that I think are going in a very promising direction. There are many more, and I'd be very happy to discuss further. So I'll stop there, and of course, I'm now happy to hand over to Gloria.
Thank you, John. That was fascinating. Thank you for saying yes to speaking and being very gifted with your insights. So I will now turn the floor over to our second speaker, Gloria. Gloria, over to you.
Thank you, Helene, and thank you for inviting me. It's a pleasure to share a digital table with John and you. I will focus I won't share slides. As I told you before we start the session, I'm very bad at preparing slides, so sorry for that. So I will be speaking most of the time. I wish you don't get bored of just me speaking with no slides. So I will focus the conversation mostly on the experience we are having here with the project of the digital euro. And as John explained in his own presentation, the views that I share here are also my own views and not necessarily those of the company I work for. So let me start. I don't know how familiar are you with the digital euro, so let me start a little bit with some background on the project. The idea of the digital euro emerged in 2020 when the European Central Bank published its first major report regarding how a CBDC would look like. A year later, in 2021, the ECB, the Governing Council of the ECB, officially launched the project, and then it started the investigation phase. By October 23, the ECB moved to a preparation phase, and this phase that has lasted 2 years is to be finished in October this year. They have been publishing reports on the developments, and all that information is available, as you can imagine. The ECB has made clear that no decision on issuing the digital euro will be taken until the EU co-legislators, the Parliament and the Council, agree on the regulation that provides a firm legal foundation for the digital euro. So before talking a bit about the complexities of the project and what it brings to the citizens and to the industry, why a digital euro? What are the underlying drivers? Well, first, it's monetary sovereignty. Today, one of the questions that drive the EU to pursue this project was the concerns about how digital payments infrastructure depends on non-European providers. Second, Europe lacks a pan-European retail payment solution, and the ECB sees this as a unifying solution. Although, as I will mention later, there's some private payment solutions that are highly successful, and we are seeing a consolidation of some of them across different countries with a relevant number of customers and adoption. Third, there is a question, and about this, probably John could talk much more than me, because this has been published in many of the BIS papers. There's a question of the money, the public money as a monetary anchor. As we see cash declining, the central banks are concerned about losing the only form of central bank money available to citizens. So a digital option is intended to extend that anchor. And the last thing would be probably a kind of fear of missing out, this counterfactual risk of what happens if the ECB does nothing. So my view is that those are mostly the underlying drivers for the EU to pursue this project. But still, there are many questions. I mean, even when we are finalizing the second phase, the preparation phase, there's still many questions that need to be answered. Where are we now? Well, as I said, the preparation phase is to be finished soon. And during this phase, the ECB has been finalizing a common rulebook. They have been also studying the question of the holding limits and engaging with banks, merchants, and consumers. Regarding the rulebook, as you can imagine, this is a very technical document. It includes a set of rules, standards, and measures for payment service providers on how to offer the digital euro when it comes. The contents cover functional, technical, risk, and many other questions, including user experience, branding, and some others. One of the questions is where is the territorial scope? And obviously it applies to payment service providers, merchants, and end users within the euro area. Although I will mention later that in a, I would say, very preliminary way, it forces this rulebook that some cross-border, well, not the rulebook, sorry, but the regulation, one of the two regulations that are that are draft and in current process, they foresee that it could be, I mean, the digital euro, there's some situations where it could be arranged to be used outside the EU, but I will mention later because this is not mature at all by now. Well, the document is a technical document, the rule book. It cannot be used as a legal implementation basis until, as I said, the legal decision is adopted. And once the legal decision is adopted, it will need probably to be reviewed. There are many questions that still need to be addressed, and some of them have been addressed during this process, but they need to be sought out somehow in a final way. One of them is the compensation models, fee structures, holding limits. Now we learned some days ago that the country, the members, the state members want to take part, a serious part in the decision of the holding limits, because it can affect financial stability, as I will mention later. Just to mention, because this is a super complex process from my point of view, so just to mention some challenges coming from the design questions. For instance, the rulebook, instead of building the use cases from small to big, like in other innovation processes where you can see first it is a minimum viable product that is built, and then it escalates and becomes bigger and more functionalities are added along the time. The digital euro rulebook covers from the beginning a multiplicity of use cases. And part of the challenge here is that it could be seen as too wide and ambitious. Also, another question is whether a specific standalone app is created for the digital euro, and this also has some benefits, of course. It can be probably put together with digital identity, features, and many others. So that's probably good for the citizens. But there, the creation of a specific standalone app also has some challenges because it doesn't take advantage of other existing solutions that already exist and they are in use by the European customers. And changing the way people use the tools when they get used to some kind of user experience, some type of tools, is not so easy. Additionally, creating new tools generates compatibility, connectivity, and standardization issues. And all of them, as you can imagine, generate costs. An example of this is how the project is foreseeing what they call a digital euro account number. Now, for you to understand, in Europe, we use the IBAN, the international bank account number. I think in the US is the routing number or BIC. But now creating this new number also requires compatibility and standardization measures. Now, let's turn to one of the, for me, the most important questions here. And it's about retail CBDCs versus wholesale. Well, the retail CBDC and the digital euro is foreseen as a retail CBDC is designed for everyday payments, and it person to person at the point of sale and many others, but it comes with many risks. If one of them, and there are a lot of studies about this, one of the risks that the banks and the industry have been mentioning in different fora is if citizens shifts deposits from banks into the digital euro wallets, it could drain retail funding. There's some studies, and I invite you to check some of them, like, for instance, the Copenhagen economic study. It says that a holding limit of 3,000 euros, for instance, could mean a loss of up to 10% of household deposits across the Eurozone. And the impact of this is wide, because it could imply that the bank's ability to fund the economy is affected. There are other sources, as I said, there are many other reports. I like also the report from Bruegel in 2024 that concluded similarly about the impact in financial stability. They said subject to wide adoption of the digital euro, and adoption, of course, as I said before, is a question here that needs to evolve once the project takes place. In contrast, in contrast to the retail digital euro, we have the wholesale digital euro, and it offers clear benefits without these risks, from my point of view. The wholesale CBDCs are a new digital representation of central bank money designed to improve how large value payments and settlements are made. They have many benefits, including they can streamline liquidity and treasury management. They can support the development of tokenized capital markets. They can enable safer and more efficient settlement, and also reduce counterparty risks. And probably even modernize areas like trade finance, embedding payments into digital processes, introducing conditionality, and other questions that would be desirable. And for these reasons, from a banking perspective, the wholesale option is both safer and more promising. Of course, Europe is not alone in this debate of the retail CBDCs. Although the debate and interest of the retail CBDCs was very strong in the latest years. We've been, I think 2 years ago when I was at the IIF, it was, we were talking all the time about this, and it still is very relevant. But what we have seen is that some projects have somehow lost some momentum. In the just retail CBDCs arena. And that's for different reasons. In some cases, this has happened due to technical questions like privacy, scalability, or cost, like the Brazil DREX. In other cases, it seems that the regulators are reconsidering the need for a retail CBDC, provided that the commercial innovations, the private sector innovations, are enough. And this seems to be more the case of the UK. As you know, we have different approaches. The United States has stopped completely any retail CBDC issuance earlier this year with the executive office, with the executive order touching on this. We also have a completely different case, which is China. They have been piloting the e-yuan primarily for retail use since 2019. And according to the Atlantic Council, this e-yuan has about 260 million wallet users as of June last year. And the amount of transactions at that moment, June 2024, amounted circa 1 trillion USDs. And they are also considering internationalization. So one of the movements that we are seeing here is how this retail CBDC can move maybe outside China, and maybe and how this will have probably many considerations that we don't have time to treat in this session. Well, we have other examples with retail CBDCs in place, like Nigeria, Bahamas, and Jamaica. But in those cases, there are other objectives, such as financial inclusion, and that don't play in the European Union. In my view, who runs the rails and what goes over them is a key question. And I guess that in some years, we will be seeing many things going over rails, different things. I like, John, this idea of tokenization and how the BIS work on that in the last years. And in that sense, the BIS Innovation Hub is coordinating projects like Agora and Bridge, which explore the tokenization and wholesale CBDCs for cross-border use. But I'm not the more suited person in the room to talk about them. For me, the lesson here is clear. While many countries have retail pilots, the real momentum is in wholesale space because the benefits are clearer and the risks will be more manageable. If I have the time, I would like to touch a little bit on cross-border payments outside the European Union and the relation with the digital euro. One of the ECB's selling points of the digital euro is that it could improve payments across Europe. But when we look beyond the EU, the picture is less clear. It is true that the proposed regulation for the establishment of the digital euro forces that under certain circumstances, there could be a natural or legal person located out of the EU who can receive digital euro services. But this seems, at least to me, quite complex, because this needs bilateral or multilateral agreements that cover questions like regulation, supervision, interoperability, and operational safeguards. So it's still very early to talk about this. So the digital euro as a retail CBDC is not designed to solve the complexities of cross-border transactions. By contrast, wholesale CBDCs, and specifically some multilateral projects coordinated by the BIS, seem more promising. For global commerce, other thing that we are taking a look at is the interoperability between private initiatives, as well as between the central bank digital currencies, and how all this will be key. In terms of private initiatives, I'm sorry because I'm focusing my presentation mostly on the EU, because I'm constraining most of the ideas to the relation with the digital euro. Well, in the EU, we know that the digital euro could compete with the existing banks' payment solutions, impacting fees, funding costs, impacting also credit availability, as I said before, and increasing competition from non-banks. But don't forget that Europe has many private solutions that achieve many of the same objectives as the digital euro. And the private sector here is moving forward to promote interoperability between those projects. I just want to mention a couple of relevant initiatives that are in place. One is the European Payments Initiative with Wiro that aims to provide a pan-European wallet. This is an initiative led by the Central European countries like France, Germany, Belgium, and the Netherlands. And the second initiative I wanted to mention is the European Payments Alliance. This alliance is working to connect national schemes and create an interoperable instant payments network across Europe. It works in Spain with Bizum, Italy, Banco Pay, and Portugal with MBWay. They are already connected with more than 45 million users. I can just take my mobile and do a quick payment, an instant payment through this network to Italy or Portugal. The good news is that in June this year, both initiatives, the European Payments Initiative and the European Payments Alliance, announced a collaboration to interconnect their payment solutions and pursue cross-border interoperability. Their joint ambition is to reach about 15 European countries and to cover circa 382 million people, which is approximately 84% of the EU plus Norway. It is expected that they release the feasibility study for their interconnection at the end of this year. These initiatives demonstrate that the private sector is innovating fast. And the private sector also promotes the European sovereignty, reducing reliance on foreign providers and leveraging existing infrastructure. In many ways, the private sector might also deliver results more efficiently than a central managed digital euro. I was to touch also on stable coins, but John, you also mentioned the figures that I had here in my screen, although some of them are not exactly the same because different reports provide different figures, but I was also to mention the nearly circa 300 billion stable coins up to date and how they the market benefit with these stable coins in the use cases of remittances, cross-border trade, inclusion, and programmable payments. It is also impressive the forecast for 2030, as you saw in your screen before. It is just amazing how we move from talking talking about billions to talking about trillions. So let's see what happens in 5 years. By now, well, I just wanted to mention that by now this stablecoin panorama shows a clear dominance of the US dollar as a reference asset. There's very limited traction for the euro or the British pound, as 90% of stablecoin supply remains US denominated. In the US, there's the Genius Act. In Singapore, the Massachusetts Authority of the Authority of Singapore, the Monetary Authority of Singapore released the regulation in 2023, and now the UK have the FCA consultations this year. They already, Singapore, US, they already have clear scalable regimes with strict prudential safeguards. 1-per-1 reserves, redemption guarantees, strong oversight, and so on. So what is important to have here in mind is that tailored rules can support innovation under supervision, because the risk, as John mentioned, is when crises come. So the important thing is that there are rules, there's supervision, there's proportionality in those rules and supervision, so we can allow innovation at the same time. I didn't mention the EU, and that was on purpose. The EU was the first to regulate the stablecoins with MiCA, but probably an update of certain questions from MiCA would allow a more competitive position from the EU on this arena. What can, almost finishing here, I hope you're not sleeping by now. What can be done with all this in mind, with all the things that I mentioned, what type of considerations should policymakers and the ECB bear in mind for the Digital Euro project? Well, first, I would say that they should follow the do not harm principle. The Digital Euro must not destabilize the financial stability. That means that holding limits must be low, predictable, and designed so that euro function only as a mean of payment and not as a store of value. Second, they should ensure a fair compensation model. The ecosystem will only be sustainable if all the parties involved are remunerated. And this is important because I didn't mention that, but for the project to move ahead, there will be a huge investment from many different parties, including basically the private sector. So all these considerations, it's important that they are taken into consideration. Third, and I already mentioned this, it is important that we reuse what already exists. Europe has invested heavily in instant payments and digital infrastructure. So let's build on these foundations rather than duplicating them. Also, the digital euro must be resilient, secure, and able to function in times of crisis. And lastly, I would say that it's important to manage the public narrative carefully. The digital euro, in my view, should not be portrayed as a safer, cheaper, or more private than existing payment solutions. Such comparison risks undermining the trust in the banking sector, and trust is all in finance. To conclude, I would say that the digital euro is a bold project with a relevant political weight, but retail issuance carries some risks for financial stability, credit provision, and the role of banks in the economy. Wholesale, by contrast, offers clear benefits and global opportunities. As this debate continues and we move forward, we must insist on cautious step-by-step approach with clear regulation, detailed cost and benefit analysis, low holding limits, fair compensation, and above all, a focus on stability and innovation together. This is the path to ensuring competitiveness and resilience in the digital future. Thank you.
Thank you, Gloria. That was amazing. It's great to hear about this vision, right, that the ECB has from your perspective. I know your personal perspective, but you've been in the banking industry, so you're able to lay out the views and the risks and the opportunities there in that path. So thank you so much for saying yes to speaking today. So again, my name is Helene from the IEO, and I'll be moderating now the final part of our seminar, which is the discussion. And before taking questions, I'll just take a few minutes to remind that this seminar is recorded and will be listed on the IEO website, again, which is ieoimf.imf.org. Okay, so now we're going to open up the meeting for questions for either one of our speakers, for John or Gloria. So if you have a question for John or Gloria, please please write either your question or your name in the chat, and we will ask you to come in and unmute. So I see Tara has posted a question. So again, feel free to write your name in the chat, and I'll just to get in the queue. Tara, would you like to unmute and ask your question, or shall I read it?
I can ask the question.
Perfect.
Thanks, Helene. Yeah, it was mainly for John. I thought both the presentations were really helpful. It's just this question about policy approaches, because you focused a lot on the domestic side, and I wondered what your view was on the international side. How do you see the role of, the various international institutions, FSB, CPMI, BIS, of course, and the fund play out in this space, and like the relative roles between them?
Very good. Yeah, so I'm happy to address this question, and thanks, Tara, for bringing this in. So I get asked things like this very often. So sitting in Basel, of course, we're in the same building with the Secretariat of the Financial Stability Board, where I used to work prior to the BIS, as well as the CPMI Secretariat. There's the Basel Committee. So from outside, this looks very impenetrable and sometimes difficult to understand. And I think even inside there can be questions about what is the role of the different groups work with each other. They all have slightly different memberships, different mandates, and of course, then there are means of collaboration in practice. But I think broadly, the BIS brings together central banks and particularly the central bank governors to discuss issues of mutual importance. The BIS, unlike the IMF, we have a somewhat smaller membership. It's only 63 central banks around the world rather than the 190 or so members of the IMF. And it's only the central banks as opposed to the ministries of finance. And so that means that the BIS does have this role as an institution serving central banks specifically, all of the large central banks in the world and a number of kind of mid-sized countries, emerging markets. And so what this means is that it is a place for governors to be able to discuss these issues, to be able to be connected with research and analysis that's relevant. And then in the committees that the BIS convenes, such as the CPMI is really focused on payments and on market infrastructures, as its name says. And so in the stablecoin space in particular, our CPMI colleagues and the CPMI groups have done quite a bit in understanding the implications for payments, for settlement, whereas the BIS as a whole, our research is maybe the research of my team, for instance, can be also focused on some broader issues. But I would say that we interact a lot. The Financial Stability Board, meanwhile, is really focused on financial stability. And then, in the past, there have been groups, reports that have looked particularly at how stablecoins could affect the stability of the global financial system. And there have been, a number of recommendations and principles that have been articulated. We work a lot with the IMF, but again, IMF has a larger membership, also a number of emerging market and developing economies. IMF does lending and does technical assistance, neither of which the BIS does. And so I think that there is important work being done at the IMF and also important analysis being done in the context of the Global Financial Stability Report by IMF economists and researchers, understanding what digital money means for a very wide range of policies outside those that are in the remit of central banks. So I think that concretely on stablecoins, there is work. This is, again, a very rapid transformation. There's a lot happening. I think that it's important that we look at these things from different perspectives. And it's a good thing that we have different international groups that are able to do so. It is, of course, important to collaborate, and that's, certainly happening. But I think that the overall, goal of the public sector has to be to understand what this will mean for the monetary system, to react, to articulate public policies. And so national authorities have their work cut out for them, but they have a number of partners with the IMF, with the BIS, with the various groups that are helping them to understand these issues and to respond in real time.
Thanks, John.
Thank you so much, Tara. Who else would like to ask a question or just come in and comment? Or you're thinking about your questions. Actually, I have one for both speakers, which was prompted by, I think it was slides 11 and 12 in your presentation, John, that went back in history and showed all these old banknotes issued by private actors, like the Delaware or the shipping company, I forget. So if we're back to the future, what are the risks and opportunities of private actors, including banks, and that's a question for Gloria, issuing these newer forms of private money, like stable banks issuing their own stable coins, for example? Or is that, what are your thoughts? I guess a question for both of you.
Very good. Maybe Gloria wants to take this one first. Gloria?
Thank you, John. Well, I would say first about this example from John was very good. I remember some films also about this question, but thing is, the stablecoin phenomena is there whether banks participate or not in it, and the figures are just amazing. So what we have seen and what we are seeing is that the regulation that is coming in different jurisdictions that both John and me mentioned. It's helping safeguard and protect consumers and financial stability. Without this regulation, this would be just the Far West. So banks participating in these new forms of money, I think we bring a lot of experience in the regulated arena. So not only for these new regulations, but because of all our experience in managing risks and dealing with regulators and supervisors, and we are the most suited to participate in these new forms of money. That's my very personal view.
Very good. And so I'm happy to weigh in on this too. And I'll say that beyond what I've shown in my slides, I've also written, on a very personal note about some of these issues. So people often compare crypto and stablecoins to the Wild West. And as someone whose dad is from South Dakota and who has family from that part of the country, I mean, I do have views on the parallels. I think there are quite a few parallels there, and I think both on the positive and the negative side. I mean, we are seeing a gold rush at the moment. We are seeing, a big burst of ingenuity and creativity, but a certain amount of lawlessness and, a lack of, let's say, oversight from public sector authorities. And so I'll agree with Gloria that, banks are well placed to weigh in on this and to do. But I think that there are also things that could go very wrong with, banks, depending on how things are actually designed. So, if we're talking about banks issuing, deposits on programmable platforms, tokenized deposits and the like, I think that can be very productive. It can be very, similar to deposits today, but with new functionalities, with the continued ability to support lending and the like. But if we're talking about, creating a narrow bank on the balance sheet of existing banks, then I think things start to look very complicated. If we're talking about introducing a new type of instrument that doesn't have deposit insurance, well, deposits do have deposit insurance. You can get all sorts of very complicated, very difficult things. And so I think it really does matter how this is done, and I think that that's something that has to be given careful thought to. But I don't think that we have the luxury of waiting a long time and debating about this in depth. I think that these things are happening very quickly, and I think just to go back to the point that I was making there, stablecoins today are really tied to the issuer. If you accept $1 in Tether, then you are accepting a liability of Tether, and you have to trust that Tether is actually keeping those assets and not lying about where they're keeping them and not investing in a bunch of shady stuff that we don't really know about. So, that is a little bit like this system that we had in the past where, $1 isn't necessarily $1, isn't necessarily $1. We've kind of overcome that in our existing banking system by having regulation, by having deposit insurance, by having central banks that do clearing and settlement. So, if we do want to go back to a system that looks like what we had in the past, there can be some, new functions and new benefits from that. But there are also some important risks. And I think that, we're about to relearn lessons from history if we don't heed them from the outset.
Thank you, John. And thank you, Gloria. Does anybody else want to ask a question? We have still more time for at least 2 or 3 questions. So don't be shy. I do have a question about one of the, I guess was prompted by also one of the charts that was in John's presentation about the declining holdings of physical cash. And I guess that would be a question for both of our speakers as well, which is, are these developments leading us toward, whether it's a digital euro or stable coins or other types of tokenization, or are we going towards cashless societies? And for this audience, more macroeconomists, what implications would that have for monetary transmission or capital flows, global financial safety net? And is that good or bad for financial stability to be cashless? I guess it's more speculative, but just curious where this is heading in your view.
Good. I'm happy to give some thoughts on this first, but welcome Gloria also to weigh in here. I think that in many cases we are seeing a decline in the use of cash for day-to-day transactions. And cash in circulation is an imperfect proxy for that, because people can be holding cash as a store of value or for other purposes, or they can be really holding it to spend it. But what we see from payment diaries, from other statistical sources, is that people are really using less cash over time. And so when we talk about is it a cashless society or is it a less cash society? It might be that it's the less cash. It's not necessarily none. There are a number of groups who continue to use cash for very variety of purposes, but we are definitely seeing a decline. I would make the point, which a number of central banks have made, which is that it is very important that there is still access to cash. Cash is a lifeline for a lot of people, for older users, for migrants, for lots of people who may not have either access to existing digital financial services or who may not be well served by the existing system. It's also great in periods of natural disasters, for instance. So if we want to continue being able to pay for things when the electricity grid is out, or when there's a natural disaster or weather event, cash is very good for that. It is by nature offline. And so I think it is very important, and central banks have underscored that they will continue to provide cash for as long as it is demanded. And there should be some role for cash alongside the various digital payment options. And I think that entirely doing away with it, would be quite problematic for financial inclusion and for the ability of different users to continue to access payments. But what would mean, what does it mean from a macroeconomic perspective? Let's just talk about this less cash society scenario. I mean, certainly there are some implications. You may have more direct transmission of monetary policy because there are more things that do pay interest. Deposits tend to have some interest, so that obviously leads to more transmission of policy rates than in a system where things are primarily cash based. You have less seniorage. We're not talking huge amounts here, but in many jurisdictions, we're talking a 0.5 percentage point of GDP or so. And if you have less cash, then of course you have less seniorage revenue. And there can be, some other implications for the ability to circumvent capital controls using literal briefcases of cash, or the ability of illicit activities to go ahead and with cash payments. I mean, obviously, that can also be influenced by the overall scale of use in the economy. But I would say, again, that it's important that cash should still persist alongside a variety of digital payment options. And ideally, consumers should have choices and be able to choose what fits best for their particular needs.
Yeah.
Helene, I haven't studied this question particularly. Working in a bank would be seen probably where that I promote the use of cash, but my personal feeling is that there are many cultural questions involved here. So some places and some cultures use more cash, than others, but personally, I haven't studied this point.
I was gonna actually ask you, Gloria, to speak about the offline version of the digital euro versus the online version. So my understanding is that some countries in the European Monetary Union are really keen on having a digital euro that works offline, precisely because of some of these risks that John just outlined. What to do in a crisis? There's no power grid working or such. Is that something that's
sorry? Yeah, I'm fine. Thank you. Yeah, there is within the digital euro. Sorry for my voice. There's a project of a phone offline functionality. The thing with the offline functionality is that still many questions remain to be solved. So within the technical phase, this has been studied, but there are many things still to sort out yet. So we like how does it function in situations of crisis? How does it consolidate the information? How does it reconnect to the systems? many technical questions have been studied, and personally, this sounds like similar to the cash solution that John mentioned, but for times of crisis, but much more complex because of all these technical questions. So I think this is something maybe for a future seminar.
Excellent. Well, thank you so much, Gloria. That's all the time we have for this seminar. So we'll end with a round of applause for our two speakers. And thank you all for letting me be here today as the moderator. And thank you for a great seminar. So again, my name is Helene, advisor at the IEO, and we will now stop the recording and wish you all a great day. Thank you. Thanks for attending.
Thank you, Helene. Thank you, Gloria.